Morning, everybody. My name is Paul Joyce, and thank you very much for joining our What's Next to Invest in the Future of Your Business session. This is going live on LinkedIn this morning, so thank you very much for joining us. This is the first of three sessions we have looking at investing in the future as part of our What's Next campaign. Today, we're looking at what's often the first stage of that series, and that's obtaining capital you need to meet your strategic objectives. So as I mentioned, my name is Paul Joyce. I'm an M&A partner at Mazars in the UK, and I lead our London team. And I'm delighted to share today's discussion on the variety of debt and equity options available to you. That's going to include private equity, venture capital, private debt funds, and high street banks. And I'm also going to outline some of the key factors that consider to make sure your next step is the right for your circumstances for both you and for your business. So now on to today's discussion. I'm delighted to be joined by my colleagues Josh Thornycroft. Josh is a director on our debt advisory team, and Keith Marshall, who is an accountancy and outsourcing partner. We're going to hold a Q&A session at the end of the live discussion, so please feel free to ask any questions you have in the Q&A tab, and we'll make sure we try to pick those up at the end of the session. I think a natural starting point is to discuss the current landscape. I mean, it's safe to say that the last 12 months have been pretty eventful, and there's been a big impact on both the debt and private equity landscapes. So first of all, I'll pose a question to you, Josh. What's the impact been on the rise in interest rates and the economic uncertainty in terms of raising debt?
Thanks, Paul. The obvious point is that debt is more expensive than it was sort of 3 years ago. So the average SME loan, the data shows that the pricing of that is over 7% versus about 1% in May 2020. The economic uncertainty and the overall cost of debt, this has led to slightly tighter credit decision making versus 18 months ago. We've seen particularly conservative views towards certain sectors such as consumer and construction. And in general, the Bank of England data shows that the value of bank loans has fallen by about 14 billion in the last year to UK SMEs. I think it's important to consider, though, that it hasn't been all doom and gloom. Loans for larger businesses have actually increased in that same period by about 15 billion, which illustrates banks sort of pivoting towards what they perceive as slightly less risky lends. We're also seeing across the whole market that well-prepared businesses with good levels of information are able to access the funding that they need, especially in situations where it's to support recovering from the impact of the last few years and also to support growth and investment in the future. What's been particularly noticeable is the impact of the evolution of the debt landscape in the last 5, 6, 7, 8 years, where there are now a huge range of options available, especially to SMEs. This includes a number of new asset-based lenders, private debt funds, family offices, and these lenders have often filled the gap where banks' lending policies have tightened, so allowing for optionality for a lot of our clients and a lot of businesses in the market. It's particularly true we've seen in situations where businesses are looking to significantly invest for expansion, and whether that means by acquiring new premises, new equipment, making an acquisition, exiting legacy non-operational shareholders. And what these events have in common really is the requirement to have the appropriate funding in place. And so actually having this optionality with alternative lenders in the market provides businesses with different options of how to fund these events and a choice over different ways to structure that funding to support those investments. These lenders often have a bit more flexibility in how they structure facilities, and this is especially important where affordability can be potentially more challenging in a higher interest rate environment, but actually where there's fundamentally a good business with good growth prospects. I suppose, Paul, just flipping the question back to you on private equity. How have you seen the appetite from the private equity world in terms of supporting future investment?
Yeah, it's a good question, and obviously private equity returns are driven in part by the ability to leverage those investments so that they can drive return to the equity by using low-cost debt, and that's something obviously that they have taken a lot of advantage of over the course of the last 10, 15 years since interest rates dropped materially after the credit crunch. It has clearly therefore had an impact on private equity. Both the availability and pricing of the debt is going to feed through to the equity landscape. I think what we'll see is a drop in valuations, certainly on average. because the cost of debt is going up, that is going to impact the returns to equity. It's a natural follow on. But what we're still seeing is a lot of dry powder in the market, and what we mean by that is a lot of undeployed, unspent capital that's sitting within these private equity funds. It's committed from their investors. They want to use that money and put it to work and invest in fast-growing businesses. So we've got this strange sort of dichotomy of, on one hand, challenging valuation environment, but secondly, a need to deploy capital. So I think what we're seeing is a real bifurcation in the market. We're seeing the average valuation come down, but actually the appetite for really, really good businesses is still very high. And actually, we're seeing valuations hold up across certain sectors and across really high quality businesses, because in those sectors, there is an excess demand for investment and an excess, a lack of supply of high quality businesses. So I think what we're seeing, therefore, is valuations really holding up for the really good businesses, and people investing and private equity investing in spite of more challenging debt environment. I think what we'll see on average, and the ease for the average business to raise equity to be a little bit more difficult, and/or for the valuation to come down. So there's definitely a knock-on impact, but it's certainly not, would be a gross misoverstatement to say that the private equity market is closed, or that actually you can't go and get that sort of funding. It's definitely still available, but you just need to be a little bit more careful and a bit more thoughtful in the process that you go through in terms of obtaining that funding. Now, that's all very well and good. But how do you go about doing that, and what do you need to do as a business to make sure you give yourself the best chance of getting that investment? So I think probably now a good chance to turn to Keith and say, from your client's point of view, has this uncertainty caused businesses to rethink their approach and to do things differently?
Okay, thank you, Paul. I suppose I deal with clients across a multitude of sectors, and in the run up to this webinar, I have had a chat with quite a few people just through normal meetings and just I suppose speaking about what's going on. And I suppose starting off with house building and developers, obviously high interest rates and poor or low customer confidence are the key drivers there. And sales in those sectors, obviously you hear about it every day, but it has slowed massively, and lack of appetite, and projects are either canned or stalled after the first stage, and they might not proceed to the second stage. So there is that double impact of low customer confidence and high interest rates. As far as staying with that sector, work in progress and new projects, should the company invest in them? Should they actually tie up cash in work in progress stock? How much housing stock should be carried? Cash needs to be retained to fund growth out of the slump, if you like. But the industry is resetting in a new world, and I suppose with higher interest, I suppose it has reset for higher interest rates, and it's unlikely that interest rates are going to go down in the long term. So it's getting used to those higher rates, I suppose. Resetting is, however, well underway, and it needs to be, to be honest, because there's such a massive undersupply of housing in the market. Looking at public sector projects for same industry, again, lack of public funds mean projects are drying up and little investment in the area. Commercial projects, appraisals no longer work in many cases, and they're less profitable due to those higher interest rates. So lack of people committing funds in that area too. Looking at other clients, exporters, importers, similar idea going on there, to be honest. Exporters, people are nervous to commit to carry the stock, so nervous to invest in the business. So lack of fundraising going on there, as people believe that the discretionary spend has dried up. And same on importing, it's all about stock, it's all about managing the stock levels. For your average importer, it maybe takes 5 or 6 months to bring goods in from, say, China. And that 5 or 6 months, you have to commit cash well in advance. And with consumer confidence at an all-time low, it makes it really difficult to invest. So it's making really difficult decisions. On the flip side, with the dollar being as low, the inbound investors are actually, the UK is a good place to invest, I suppose. So interest rates do seem to have plateaued, and which is good news. And it feels that confidence can permeate back into the market. But in conclusion, Paul, to answer your point, many businesses are considering investment and having to suspend projects and not so confident about what's going on, reducing investment due to lack of customer confidence.
Thanks, Keith. That's really interesting and echoing a lot of what I'm sure Josh and I are seeing as well in the market. So we've discussed a bit about the backdrop of the current landscape. I'll turn back to you, Josh. What are the key benefits associated with getting debt finance to support your business in the future? Particularly given pricing has gone up for that sort of funding over the last 12 months or so.
Yeah, that's a good question. I think the first and foremost, it's a sharing of risk with a third party. So rather than using kind of retained earnings or cash, it allows you to spread repayments over a period of time. It's predictable, it's fixed, and that supports with budgeting and decision making, and ultimately, as I say, the sharing of risk. Clearly, as well, there are for a lot of businesses, a lot of entrepreneurs that we meet, they have sort of full belief in their business and growth opportunities for their business, and so at this stage, being able to take on debt rather than giving up some equity to support growth and support investment allows them to preserve that ownership and allows them to have the equity upside in the future, and added to that allows them to retain kind of full control of decision making as well. There are, I suppose, a couple of ancillary advantages excuse me, advantages to it as well. It's interest on it can be tax deductible, so even with a rising interest rates, it's important to consider actually the advantages of that as well. And there's also flexibility on the use of that funding too in the current market with the optionality as I've discussed before.
That's really helpful, Josh. And what do you think are the main areas you need to consider as a business if you're thinking about taking on debt finance in one way, shape, or form?
Yeah, there's quite a few here, but I think from my point of view, the most important thing is to consider the detail and the commercial aspects of the finance documents. These are often agreements that you sign up to for 3, 4, 5, 6 years. And so really important to get some of that small print right sort of up front. And that's especially true for the covenants that a business will sign up to, both financing and operating covenants. As well as also it's important to consider what a lender can or cannot do in certain situations. I think as well that the second piece that's sort of aligned to that as well, and especially as we talked about in the current economic landscape, in the current interest rate environment, actually considering modelling the affordability of debt repayments, especially under base case or sensitised or downside scenarios. It is really important to ensure that the business will be able to repay the debt over the period of time that it's agreeing to. And I think there are risks associated in taking on debt, both in terms of the impact on cash flow and also risk to shareholders as well. So very important to make sure that the structure, the profile, and the flexibility of the debt is appropriate for the particular business. And as I say, it's really around the detail and the commercial aspects of the finance documents that can help you get comfortable with that. And actually, Paul, probably coming back to you on a similar question as well. From a private equity perspective, what would you say are the main benefits of this type of financing to support investment and growth? And where do you consider the key areas within a process that you would like to consider if you're supporting a client?
Appreciate you always pushing the question back onto me, Josh. It's very kind of you to do so. But it's clear that when you're thinking about funding private equity or equity in any form and debt, are two sides of the same coin, and it's about reflecting about the balance of equity and debt investment that you want, and whether that's typical private equity or other sources of equity finance, getting that right balance is really important. And one of the big benefits of equity finance in any form, particularly private equity, is that they have relatively more flexibility and deeper pockets, and the ability to potentially take more capital on in that form as the business develops and changes is really critical. And it might be particularly in periods of uncertainty that gives you that equity gives you that flexibility to be able to adjust and change where perhaps debt with a fixed coupon, a fixed repayment profile doesn't quite give you that same flexibility. It also gives the opportunity to take capital off the table. We're talking a lot about funding growth here, but it might be that there are some shareholders in the business who want to, realize some of the capital they've invested in their business over a period of time, and certainly equity gives you that option to do so. And you also get typically more support from an equity investor, a private equity investor in particular. They don't tend to be, overly overbearing. They will probably have a seat on the board, but they can contribute to a greater or lesser degree to helping you form strategy and helping give perspective. And actually, we'll often have great contact books of people that you might be able to bring into the business, or relationships you might be able to form from a client perspective. So actually, there are a number of benefits, to getting equity investment alongside debt investment. For me, though, the really important thing, and this is especially true for businesses that haven't taken on external equity before, is looking beyond just the financial impact. The question I always ask my clients when we're talking about equity funding is, what sort of partner you're actually looking for? Is it somebody who's going to put some money in and then sit in the background and not ask any questions? Or actually, is it somebody who's going to work alongside you, who's going to help you drive the business forward? And you'd be, amazed that, different businesses have very different views on the level of input they want. Some want that capital, but they want somebody who's going to be relatively silent. Some want somebody who's going to be very involved and hands-on. I think understanding the style and the personality of the private equity house you're working with is really important. We've spent a lot of time prior to a process even kicking off, getting to know the team members, getting to know the houses, helping the business owners understand the type of person they'll be working with. And often that's as important as the valuation or the amount of capital you're going to be able to take off the table. Because if you can't work together with somebody, particularly if it's the first time we've had external capital in the business, it's going to be very difficult to make it successful. Some houses are very hands-on and they want a lot of information. Some are relatively hands-off. But understanding what the reporting and governance will be needed, how many board seats does the equity house want? How often are they going to want you to report to them, and what information? Is that something you're already doing already, or is that something new and you're going to have to create it? How's it going to impact the current management team? Are they going to bring in new people? Are there people who, as part of the transaction, are going to be exiting and will need to either be replaced or not, as the case may be? And do you, as an equity provider and a business, share the same long-term vision? Because if you don't, it's very difficult to be successful. If your definitions of success as an investor and as a business are different, then clearly it's going to be challenging for you to both be successful. And that comes to both valuation expectations, strategic expectations, but also timeframes. Equity investors typically, but not always, will have exit time horizons. Sometimes that will be 3 years, sometimes it'll be 10 years, sometimes it'll be longer term than that. But understanding again what those objectives are and what good looks like to your equity investor, and making sure that aligns with what good looks like for you as a business, is hugely important. And then thinking about what preparation is needed to be able to go through that process. And that's going to apply equally for a debt process as an equity process. But I think, knowing what that looks like, do you have enough time to repair? What's the impact therefore on timing? If you want the money tomorrow, that has a material impact potentially on who you might be able to get the funding from, the price of that funding, and the impact therefore on whether it's the right partner, compared to if you're thinking about it 6, 12, 18 months in advance. And I would always recommend the longer in advance you can be reflecting and thinking about this, the better place you'll be. Even if you don't push the button until a few months before you actually want the funding, at least you've thought about it. And if someone turns to you and says, actually, we need 12 months to get comfortable, or in 12 months, your business is going to be worth materially more, and therefore the amount of equity we need for that investment is going to be materially lower, then actually knowing that in advance helps you make really well-informed decisions. So one of the questions I often get asked by my clients is, how do we know what the best option is between debt and equity? So I will turn to Keith and Josh. Josh, probably first. How would you go about answering that question in terms of what might the best option be? Thinking about funding, knowing you need a certain amount. How do you go about deciding where to go and get it and who to get it from?
Yeah, it's a really good question, Paul, and one we do hear a lot. So there's, I think there's two sides to this. From my perspective, there's a quantitative side to it, and as you've alluded to there, there's a qualitative side as well. So on the quantitative side, there's a modelling aspect to this that looks at potential different debt structures, different types of equity structures as well, and then considers the potential returns on investment and on different options. And this includes under different scenarios for performance, upsides, downsides, sensitized, etc. And I think that often informs what is better from a shareholder's perspective, from a business perspective, and also from a growth perspective, and a lot of the factors that you consider there, Paul, in terms of timing as well. I think on the flip side, there is certainly that qualitative aspect that you alluded to a lot there around who your partner is, being really important. Even though a debt partner will be a lot less intrusive than an equity partner, they'll have a lot less involvement. There will still be involvement in the business, and whether that's by way of information requirements or rather than necessarily kind of control or board representation, there will still be some involvement there. So it is important to consider up front how your financing partner, whatever that partner looks like, debt or equity, how they might behave in certain situations. And again, I suppose linked to the quantitative side, it's thinking about those situations that are both negative and positive as well. And I think, to reiterate something that Paul said as well, spending time with potential funders and importantly the appropriate people at the funders, i.e. the people that you'll be working with kind of going forward for a number of years, and asking the right questions of them will be key to this, because it's something that we'll need to work in close tandem with kind of the key commercial terms that I alluded to before within finance docs. I suppose that was such a good question, Paul. I might flip it back to you before we pass on to Keith. What do you think? Do you agree with that, the quantitative, qualitative side of things, and how have you responded to clients on the same question around options?
Yeah, look, I think that's absolutely spot on. And, I talked about a little bit earlier, I think you really do have to balance up the quantitative and qualitative aspects of this. I think people do get very bogged down in understanding the numbers, and clearly that's really important, but they miss out on those qualitative aspects. It is about finding a partner for the business. It is about understanding how someone is going to react when the business is going well, but also when the business is going poorly. And we all know that when you write a business plan, the second that you save it on your desktop, it immediately is wrong. The world is never exactly as you expect it to be on a spreadsheet, and therefore understanding how the partner's going to react, for better and for worse, when the business improves and gets worse, a little bit like a marriage, I suppose. You want to spend that time, getting to know who that partner is and understanding that you can work together through the ups and downs. So I think that's actually really, really important. We've touched a lot, I suppose, on finding that finance and how we obtain the finance, but a key part is obviously the process that you go through to get to the point of getting that finance. And one of the things we often talk about, and I talked about there about the preparation, and how MI, management information, is really, really important. Keith, you spend a lot of time with clients, building up finance functions, understanding the importance of MI. What do you think are the really key areas that make up good MI, and how do you help your clients as part of that process, to make sure they're really ready to go when they go through the process of obtaining that finance?
Okay, thanks, Paul. To answer that question, I'll maybe start with thinking about two examples of current clients I'm working with at the moment. Firstly, a client where they have had poor MI for probably as long as I remember, and in this situation, when finance is required, the bank will probably almost always require a complete rebuild of the data that's there, making up, having to go back and retrospectively recreate numbers, as well as then creating one-off projections. This is all required before discussions can happen with the bank, and before even they can work out how much finance is required. So, and also before you can start building a case for credit. So it makes it really difficult. Another example, client recently raised a good amount of money, working capital, and that was on the back of having regular monthly MI prepared by our outsourcing team, but equally it could be prepared by best of breed finance team. And what's happening there is we've got monthly regular MI that includes all the multiple KPIs and cash flow forecasts and everything that's required by the bank in order to get a good 360-degree view of what's going on in the business. And then funding becomes simple and the decisions are made really fast. So there are probably two scenarios. Bankers, I would also say that bankers are like the rest of us. They love good communication and they love fast and accurate information. They really do not like opaque numbers and meaningless information. So it's really important to think about your approach with the bank. I'm preaching to the converted here. I don't doubt for a second. But when it comes to the key areas in MI to think about for the funder, what I mentioned earlier about that 360-degree view of the business, I think it's absolutely fundamental. It's something I think about most frequently when I'm thinking about MI. It's about looking back, looking at history, not just of the current financial year to date, but of previous years, looking at trend analysis, and also looking forward to 12 or 24 months from the current financial position. So you've got a good idea of what you're currently at, where you've been, and where you're going to. And you're doing this all with reference to prior year analysis, budget analysis, and reforecasting of those numbers on a regular basis, and constantly having a pit stop to say, okay, where are we at? Where were we expecting to be, and where do we need to be? Same analysis is probably required not just of the whole business, but of business units or by department, and of sales analysis. KPIs such as turnover per employee, average cost employees, dead straightforward. You need KPIs that are specific to your business. Every industry has got its own needs for KPIs. And if you're importing or if you've got FX exposure, it's constant review of for example, your hedging position too. So it's not just about what your FX, gains and losses have been for the year to date. It's also about what you can expect based on the contracts you currently have, forward contracts and whatnot. Analysis of working capital days between WIP, stock, debtors, creditors, and also maybe doing it on a departmental or a business unit basis. So these things are all really, really important. And full circle back to the bank, back to that 360-degree position, bank covenant, looking at your covenants historic and also projected. So if you have got a good idea of what you're expecting to do with your business profit-wise and cash-wise, it's trying to understand what is the impact on the covenants for the next 12, 24 months to make sure you can see issues coming as they happen. So I suppose the funder is basically looking to understand profit trends, cash being generated, and the strengths of the balance sheet at that point in time. And Paul, you say how we help our clients. Whenever we are sitting down with our clients, it's on an outsourcing capacity, which is replacing or helping finance teams. It's really taking each of these areas and trying to work out how we can help most, starting with a blank sheet of paper. How can we help our clients to actually get in that good position for financing decisions?
Yeah, I completely agree there, Keith, as well. I think for bankers, they have a very short period of time to understand a business. So KPIs, profit trends, and understanding how the business makes cash is so fundamental. And we've got a very good recent example actually of where this has worked, kind of working alongside Keith and his team. So with a client which had grown, I think, nearly tenfold in the space of a year after investing heavily in sales function and winning a number of new contracts, but the finance function frankly hadn't caught up with this pace of growth, and this was fairly recent, and they were having challenges in hiring finance people quick enough, which is something that a lot of our clients are saying as well. And we initially had a lot of strong appetite in the market to support such a high growth business, and with brilliant business model and strong management team. From a commercial and operational perspective, it was really attractive to a number of different lenders. But given the current macro environment, especially, the finance function became a really important risk area for lenders. As Keith said, having quality information really does provide comfort to any lender, and it was something that we flagged up front, and we involved Keith and his team very early on, and his team was able to support the business with sort of short-term outsourced service that allowed for the preparation of monthly MI, and along with a suite of KPI information, covenant information as well, that was all of the information that a particular lender wanted to see, and it also supported a lot of the assumptions that were underpinning management's forecast, since it was based around that clear data on KPIs. So a lot of that work really did give the lender a lot of comfort and allowed us to progress the transaction much quicker than we otherwise would have done. And that debt facility in itself has been fundamental to support both short-term working capital, but also the continued growth of the business. And actually, it's interesting hearing from them recently where they said some of that information has also helped with decision making for management in terms of being able to split by business units, understanding return on investment for different business units, and therefore it allowed them to decide where to invest more heavily than in other areas. So it both helped in that sort of process with a lender, but also helping in kind of management decision making going forward as well.
And obviously, one of the things that we see is, as businesses grow and develop, there's a sort of the business accelerates and grows sales, but then the business in the back office catches up, and sometimes that happens very sort of seamlessly, and sometimes there's a bit of a lag, and the business is so successful that it sort of struggles to keep up. Keith, I suppose a good question for you. As businesses scale, particularly if they're scaling quickly and/or getting towards a position when they want to exit, how are you seeing the need for the finance function to develop? Is that an area that tends to keep up? Is it one that lags behind a bit? What sort of sources of MI are important in that process? What software is perhaps available to help people sort of manage as the business grows, particularly if it's growing quickly and is looking for capital?
Okay. Thanks, Paul. Yeah, it's a good question. I suppose it's all about technology, and it's probably one of the areas that's closest to my interest. I suppose it's to answer your question first of all about lagging, or is this decision taken in advance or behind? Far too often, the decision to actually have change technology to make sure it grows with the business is actually taking, retrospectively, it's done after the event, and it's for that reason it's done too late. There too infrequently it's done in advance on a proactive basis, and so the sort of thing I'm talking about here is, for example, lots of businesses that are going through that growth phase, perhaps going from being a 10-20 million pound business up to something 20 million and beyond. You'll probably find that the smaller and simpler businesses, there's no rules here, but the smaller and simpler businesses will be using packages that are more appropriate for SME. For example, Xero, and Xero is a great accounting system. It is fairly basic, but when you add on the various apps that revolve around Xero, you can actually turn Xero into something almost akin to an ERP type system. It'll never become ERP, but sort of enterprise resource planning is what I mean by that, which is what's used by more mid-market companies. But you can actually achieve a heck of a lot with Xero and a lot of apps. There's perhaps 600 or 700 apps that revolve around Xero. More importantly, for those growing businesses, Paul, to answer your question, is businesses need to be looking forward beyond those smaller systems to an ERP type system used by those mid-market companies. For example, NetSuite. So we partner with NetSuite, just new partnership with them. And NetSuite is probably the number one ERP system in the market, and it's cloud. It means you don't have to have complex I suppose applications saved in your networks. It's all about using it in a software as a service in the cloud. Cloud ERP benefits of this are multiple. I'll just mention a few of them, but there are many benefits. Numbers that stack up. Okay, multiple apps. If you're using Xero and apps, what you've got is you've got an app sitting alongside Xero. They speak to each other, which is great, and often will do a great job. But never to be 100% relied upon, because when things start going wrong, the data between them, or there's changes made to the business, one doesn't grow with the other, meaning actually you'll end up having to do manual reconciliations between the two. And when you start doing that, you're never quite comfortable with things working as it should do. You compare that to Cloud ERP, where it's all built into one, and there's fewer data, there's fewer errors due to data, and much greater reliability. You'll also have multi-entity consolidation. You've got a single platform, multiple entities consolidated easily with that single platform. The smaller systems do not do that for you. Reporting for more than one country. If you're overseas, then the likes of NetSuite or other ERPs will allow you to grow overseas easily through local reporting from an accounting point of view, but also through handling the local taxes. Scalability. If you, to use Xero as an example, there's a finite number of transactions can be recorded in Xero and other similar systems. NetSuite, millions of transactions. It gives you complete room for growth. And when you're looking at sale or investment, which is more about what we're talking about today, when a business is going through the process of either sale or raising money, there has to be, you need robust financials, you need quality financial information. Having that ERP system in place answers those challenges, and it will accelerate the process of fundraising or sale, and quite frankly, make sure that the financials are more reliable. So all in all, what I would say is that cloud ERP, it will make the process an awful lot easier.
That is very, very helpful, Keith, and really appreciate both you and Josh spending the time to talk us through some of that stuff. As we now approach the end of the session, and we will have a little bit of time for Q&A, and if people want to ask any questions, we have the Q&A function on our Zoom. If you put your questions into the Q&A, we'd be delighted to answer them. But if we were to leave one takeaway each, Josh, Keith, what would you think that would be? I'll turn to you first, if that's okay, Keith.
Sorry, was that myself, Paul?
What if you take?
I got it. Sorry. I think it's just thinking ahead. Going back to the question you made earlier, it's all about planning ahead. If we don't plan for your finance team to grow in advance of your business, quite frankly, the finance system and potentially the finance team will hold you behind. So it's always putting that first rather than second.
I think
what's your key takeaway for the audience?
Yeah, completely agree with Keith that the preparation is key, but I think another key takeaway for me would just be consider your options. There are a lot of options in the market at the moment across both debt and equity, and it's important to make sure that you make the right decision, because these decisions that will be with your business for a number of years. So lots of options, and consider those options.
Brilliant. And I think from my perspective, it's about finding that right partner beyond just the numbers. The numbers are clearly important. Keith has talked very eloquently about the need for good MI, but I think once you move beyond that, working out who the provider of that capital is, and that is somebody you can work with, I think is really, really important. You can have the right amount of capital, but from the wrong person, and it's just not conducive to being successful in your business. So I think that's very.
Paul, can I interrupt you, Paul?
Yeah, please do.
Just thinking of a client where if it's for exactly that scenario within the last probably 6 months, a client of mine that did a buyout of a existing client of mine, and it worked very well and all went well, but within many months it became quite clear that it wasn't the right partner, and they're now moving. And you've got to make that right decision at the start, haven't you?
Oh, I completely agree. We see businesses that go through 2 or 3 different equity partners over the journey of 10 years with fundamentally the same business, but growing. And sometimes that period is very, very successful, and sometimes it really isn't, and that is all down to the relationship, as you would have in any boardroom, making sure you've got the right personalities. When you add somebody external into that boardroom, that makes a big difference. And the success or not is very much down to whether those people can work together. So look, I think that's really very, very interesting. So we do have a couple of questions, and I will ask again, if anyone wants to add any more questions via Zoom, please jump into the Q&A and do so. The first one we've got is one for Josh, and that is, what happens if I have existing debt that I need to refinance? Is that going to be an issue? Am I better off taking on additional debt to the debt I have, or refinancing the whole thing?
Very good question, and clearly it would depend on kind of particular business, particular situation. But it's certainly something that we're seeing a lot of at the moment, where a lot of businesses, majority of businesses, probably took on some form of debt over during the COVID period, and often that was on top of existing debt that they had, and therefore they're in a position where they have a lot more debt than they've ever had kind of in the past. Yet they're in a position where they have opportunities for growth and for investment to further grow the business. So it's something that we're seeing a lot at the moment, and in some instances the right thing to do would be to work with an additional debt provider where perhaps there's a small top up that's required, and we would call these providers kind of junior debt providers, mezzanine providers, so providers that would be subordinated to your existing senior lender. Often though, this comes with its own complications. There are often things like intercreditor agreements between those two lenders that you have to agree. So in many circumstances, actually it's easier and preferable for a business and a management team to simultaneously refinance all of the debt they have in the business, and simultaneously fund kind of future growth as well. And to my point earlier around optionality, there are a lot of lenders who would be willing to do all of that and do it all in one go, and often that's the simpler, more efficient route for the business. But again, it comes down to the individual situation and how you plan it.
So presumably, Josh, the recommendation might be to come and have a chat with you and work through the different options, see what it means, see what the pros and cons of each of them might be, and work through it on a case by case basis. That it's not a simple answer as ever to these questions.
It's not a one size fits all at all. But again, just come back to the key takeaway: there are options to it, and there are advantages and key considerations that need to be made with all of them.
That's very helpful, Josh. One for you, Keith. Why are Xero and the apps not a good option by comparison to NetSuite?
Okay, thanks, Paul. I've probably covered some of this a little bit earlier, but I'll maybe pick up on some of the points that I haven't mentioned, maybe more around, for example, cost. Believe it or not, having, when you outsource with ourselves with NetSuite, the cost of actually the technology, ERP technology, by comparison to some of the smaller softwares out there, is actually cheaper. It's it's a lower cost, which is probably not expected by I suppose many people in the market. The NetSuite has built-in functionality that will for example, workflow is built in there for almost every task, meaning that you've got less time required for processing transactions and more reliable data coming out the other end. Because you're using a single platform rather than multiple platforms for your work, it's going to be less work involved in doing it, and also you don't have to push it across. It's all in one platform. It's easier for that reason also to interrogate your data. You don't have to flip between logins. And ultimately, for me, the biggest reason is your financials are able to be an awful lot more reliable at the end of it.
Thank you, Keith. That's very kind. There's a question, I think, for me, which is for a process to raise private equity funding, how does this process or information requirements differ to that of a debt raising process? I think the answer to that is there is a lot of overlap. A lot of the things that Keith talked about in terms of importance of MI, following and tracking key KPIs and data is fundamentally going to be the same between a debt and an equity process. What I would say is that the focus on a private equity investor is on potential return to the business over a period of time. So they are focused much more on the upside and the opportunities in the business, the growth opportunities, and how the business might outperform its business plan over a period of time, where debt, and tell me, add in anything here, Josh, that you think is relevant, we'll be more focused on the ability to repay the debt and the interest and to manage any downside potential. They're focused very much on ensuring they get their capital back, whereas equity is looking at trying to generate a return and over and above return on their return hurdles. So I'd say that they are similar, but with firstly probably more detail required in an equity raise, There's obviously greater risk when you're putting equity into a business, and therefore there is probably a greater level of scrutiny in terms of information requirements, due diligence, and the like. Plus, obviously, when you're acquiring equity, you're picking up potential liabilities within the business as well. As a shareholder, you are responsible for the liabilities and such that come with the business. So there is a level of legal due diligence as well as just the financial due diligence that becomes really important for somebody who's investing in the equity of the business. There is a greater responsibility, a greater risk, and therefore naturally a greater level of due diligence. But also just, and one of the things that Josh and I do when we're preparing businesses in this way and preparing information is thinking about what the recipient is looking for. And it's that subtle lens difference that I think is really critical, that an equity provider is looking for something slightly different from the investments it makes than a debt provider is, and therefore making sure you highlight the right areas. You understand that kind of beauty is in the eye of a beholder perspective is really important, and therefore whilst the information, profit, revenue, the key KPIs might be very similar, the way you might present them, the way you might articulate them to that capital provider is very different between a debt and equity provider. I'd say anything else, Josh, on that's worth adding from a debt perspective?
No, I think that's covered it.
I don't think we've got any other questions. So thank you very much for everyone who joined today, and thank you to Josh and to Keith for giving some really great insight. That was extremely helpful, and obviously not something you can do justice in 45 minutes, but I think we covered quite a lot of ground. For the attendees, thank you very much. We'll be providing a feedback form as part of the follow-up email, so please let us know any feedback from today's session and any topics you'd particularly like us to cover in future webinars. It obviously really helps us make sure we tailor this so it's as helpful to you guys as possible. As I mentioned earlier at the beginning, this is part of a broader series called the What's Next for Business series. So look out for future webinars where we'll be covering a whole range of topics, including how to invest in the future of business, succession and exit planning, as well as one on business resilience, which is particularly relevant given the current economic climate. In the meantime, you can view the first webinar in the series, which was What's Next to Grow Your Business. That's on our website, and you'll see all our upcoming webinars in the series along with dates and times for those. Our next session is on the 19th of October, where we'll be looking at innovation and sustainability, and particularly focusing on things like tax relief available to support this, as well as how to embed a sustainability strategy within your business. If you've got any questions for Josh, Keith, or myself, please don't hesitate to get in touch. We'd be more than happy to help and set up a meeting to have a chat through your specific circumstances, and always happy to give you some initial views and help you guide your thinking. You may be very early on in that journey at the moment, but as I said right at the beginning, preparation is really important. So if it's helpful to have a half an hour with us to chat through your thinking, to get some reflections, we'd be more than happy to do so. So once again, thank you very much for joining, and we look forward to seeing you again soon.
Thank you.
Thank you all. Cheers.